All right. Welcome to the show.
All right, here we go.
Another week on the road.
Yeah, crazy week too. I mean, two big events this week, right? Now we're into the first full week of Israel Iran situation.
Is there a war
strangely?
going
I don't want to call it a war yet, right? I mean, strangely, the market certainly doesn't think so.
You know what's crazy, and I hate to admit this, how I'm just so into other things that, like, I didn't watch the news all week. I haven't. We got graduation going on, family in town, all kinds of stuff. I honestly didn't know about it for like a day and a half.
Yeah.
Somebody texted me and asked me, and I'm like, I don't know what you're talking about.
Yeah, it was interesting because it was last Thursday, right? Not Thursday this week, but the Thursday before. It was started at 11:30 p.m. our time, and if you watched like the E-mini futures and Bitcoin, because those are the two things that basically you can watch 24 hours and you see what happens like while the news first breaks. It's not what you would expect, and this week's trading wasn't what I think people expected.
The weird thing to me is like how connected we are now, right? Phones, TV, everything, right? And I wasn't aware. Like, it didn't come through my phone. Like, I didn't get an alert that somebody started bombing somebody, which I think is just kind of odd. But anyway, yeah, I was
your alerts. I'm surprised you didn't get it.
I know. I mean, I have everything set up on my phone. It's not like I cut it off, but yeah, it was really weird. I mean, it was almost 2 days before I figured out what was going on, and then of course now I'm paying attention. But all right, man, tell us what happened in the market, what we thought was going to happen, and what actually happened.
Yeah, there's some pretty interesting charts about that. So we'll take a look at what happened this week from the economic perspective. Obviously, the two big ones were the continuation of the conflict between Israel and Iran, and then the Fed meeting on Wednesday. So we'll look at the highlights from the Fed meeting, the war fear trade that didn't happen, at least not yet, and we're over a week into it. And then Bitcoin, I'm going to look at again for a pretty specific reason, and then the TSP fund charts. So what happens this week? We got, like I said, last Thursday, not this past Thursday, but Thursday before, the kickoff of the Israel-Iran conflict. So continuing this week. Then on Monday, we get the New York Empire State Manufacturing Index that fell to -16 in June from -9.2 in May. So what the Trading Economics, this is a great site if you guys want to take a look at it. But New York State Empire Manufacturing Index drops to -16 in June from -9.2 in May. It was well below market expectations of -5.5, which actually would have been a rise from -9.2 in May, right? So the analysts were expecting better news than what we got in May, and we got much worse news, signaling a further deterioration in business conditions across New York State. This marked the weakest reading since March's 2-year low of -20. So at least up in New York State, the manufacturing side of the economy, right? Because we have the services side and the manufacturing side. Manufacturing side is not looking good. Then we had 3-month bond auctions this week closed at 4.24% versus 4.25% last week. We were talking about how it's part of the fear trade. In this case, it's kind of interesting because it was actually basically flat. So we're talking about how the bond vigilantes are going to push yields up. It'll be harder. It'll be in addition to the deficit if we can't sell these bonds at a decent rate. And so this bond auction, the rate did not go up very, very much, which is kind of interesting given what happened the beginning of this conflict. And the 6-month is kind of the same, right? 6-month bond auctions, 4.155 versus 4.150. So basically they didn't move very much. And then the 20-year was down, I mean, relatively significantly to 4.942 from 5.47 on the last one. So the big worry was that rates were going to go up. We couldn't sell the bonds and all that. But with yield coming down, things roughly flat is a reflection of the fear trade. And we're gonna get to that a little bit. S&P was up 0.94%, even though, again, that was Monday. That was the first trading day of this conflict kicking off, right? basically last Friday was actually the first trading day, but over the weekend a lot of things had happened, and so I don't think anybody was looking for an almost 1% rise in the S&P on Monday. Tuesday we had retail sales month over month down almost 1% versus 0.1% last month. So again, retail sales is falling, but they think it's in anticipation of tariffs. U.S. export prices were down 0.9 month over month. That was the biggest decline since October 2023, and S&P was down 0.84% on Tuesday. Then on Wednesday we have the Fed meeting, interest rate announcement, the press conference. I'm going to get to that a little bit in the highlights from the meeting, but we had the 30-year mortgage rate fell a little bit to 6.84 from 6.93 last week. New applications also fell 2.6% after they rose 12.5% last week. So still a lot of volatility in the housing market. S&P was basically flat, down 0.03%. And Thursday, the market was closed for Juneteenth holiday. And then Friday, we had the Philly Fed Manufacturing Index, which is kind of the sister to the New York Empire State Manufacturing Index. But in Philly, it stayed the same. It was -4 in June. It was also -4 in May. And then we had the Conference Board leading economic indicators were down 0.1 after falling 1.4% last month. We haven't talked about this in a while, but the Conference Board leading economic indicators are one of the really good indicators of recession. So this is a chart of coincident economic activity. It's the leading economic indicator chart. And the past recessions are the vertical green lines. So you can see the leading economic indicators tend to go up along with the market, of course, for the majority of the time. And when they roll over, it's a good indication that a recession is on the way. So this is the recession in 1990, the recession that started in 2000 to 2001, and then the great financial crisis, a little bit sideways there in 2015-16. We did not get a recession, arguably, from COVID, but there are a lot of people that think we're in recession now. This is going to basically stay flat, this chart. So it hadn't been updated because the numbers actually came in at 10 o'clock on Friday morning as we're recording this. But this big move down right here was that 1.4% down last month, and it basically stayed flat. So, but it's at a serious double bottom right there. Any continued decline, I'm sure, is going to put us in an official recession. So it's going to be an interesting summer to see when they finally decide to say that we're in recession, if we get there. Okay, so highlights from the Fed meeting. So interest rates, they held steady at 4.25 to 4.5%. It's the fourth time they held rates at that level since December 2024. This FOMC meeting, every other FOMC meeting, they put out the summary of economic projections. And this meeting, this Wednesday, they put one out. And what they do is forecast going forward for the rest of the year. So basically everything, the rest of this that we're going to talk about is the forecast for the end of 2025. It's not what's happening right now. It's their forecasts. So they're forecasting GDP growth to drop to 1.4% by the end of 2025. In March was the last time they put out this forecast, and it was at 1.7%. So it's declining. PCE inflation, they're expecting to rise to 3 to 3.1%. So that's 50% above the 2% target. It's a little bit below 3% right now. I think it's like 2.4, but they're expecting inflation to rise based on the tariffs. Unemployment is inching higher, projected to be around 4.5% by the end of the year. It's 4.2% right now. So these are really the two things. If inflation continues higher, which, like I said, it's about 2.4, they're expecting it to come up to 3 to 3.1, and unemployment goes higher. Right? Right now it's 4.2. They're expecting it to be 4.5. So rising inflation and rising unemployment is stagflation. That's probably the biggest risk. And it's a thing we haven't seen since the 1970s. It's really difficult for the economy because as inflation goes higher and there's higher levels of unemployment, it makes life really difficult for people. So the Fed pushed out timing and pace of rate cuts. They're still expecting 25 basis point cuts in 25, but there are more Fed officials, now 7 out of 19, leading toward no cuts. So they're definitely concerned about the inflation expectations. And Powell warned that tariffs may elevate inflation because someone has to pay for the tariffs. The thing is, they don't have any data, any hard data yet to see what the result of the tariffs is going to be. And seeing as how the tariffs, seem to change week to week, there's no way to forecast it. But they're obviously worried about inflation. So he highlighted stagflation risks, citing slowing growth and sticky inflation due to trade and geopolitical shocks. His big emphasis was on uncertainty. While on the one hand, he said the uncertainty is more certain, which the language gets really stupid, but he emphasized the level of uncertainty, and it's basically because of trade tariffs, Middle East tensions, and forthcoming economic data will guide future policy decisions. So one thing that people picked up on was he declined to rule out that no rate cuts may be needed, right? He declined to rule out that no rate cuts may be needed. So he didn't want to say that we're not going to cut rates, because the market wants him. It would be bad. It would be very hawkish. They would view it as hawkish, and the market probably would go down if he came out and said that, yeah, we don't expect that we're going to cut rates this year. But he didn't take that that possibility off the table. He just didn't come out and say it. And he reiterated that the Fed is, of course, well positioned to act quickly when data provides clarity. So a whole bunch of nothing, and that was not nothing, but it was reflected as basically not much movement in the stock market. Okay, so the war fear trade that didn't happen. When I was listening to the first kind of conversation about how significant that strike was from Israel on Iran, it wasn't like the normal kind of tit for tat stuff. It was a serious attack on Iran. And so I expected the market to be falling this week just based on that. But what's interesting is you didn't see it in the market. So I'm going to look at 4 or 5 charts that kind of show that should be exploding to the upside when fear kind of gets launched into the market. So the first one is gold, right? Everybody knows that when things get really scary in the world, people huddle around gold. And this was the first trading day, last Friday the 13th, first trading day after the initial salvo of that conflict. Gold popped, which you'd expect, but then it immediately rolled over, right? And so this is Thursday's close, or well, Wednesday's close. So definitely you would not expect, if during the first week of the conflict, gold to roll over, right? So that's kind of the first indication of there's not that much fear about this. The second one was treasury yields, right? You would expect yields to come down. The price of bonds goes up when yields comes down, right? So if you're going to have a flight to the safety of bonds, the price of bonds is going up, but yield is going down. So initially it fell, right? It opened at the bottom of that rectangle on Friday, but it came back up and closed at the top, right? So not that much happened. There was a little bit of volatility because, the market was acknowledging that this conflict was going on, but nothing major in yields. And then the corporate yield. So high yield bonds tend to react more than the 10-year, right? It's much more volatile, and nothing has happened. And the dollar, right? If there's going to be a big fear trade, the dollar is way down from its high, so it's way oversold anyway. You got a double bottom here, and it did, pop a little bit on that first day, but it hasn't really moved. So there's no fear trade happening, right? The only concern, and it's really the only one that I could find, is on the VIX. So you'd expect the VIX to spike, which I wouldn't call that a spike, but it did have a pretty good jump on Friday. But then nothing this week. It's above that 20-day moving average line of the VIX. Right? That's a little bit concerning because as long as it stays above that 20-day, it's likely to continue higher. But that's the only chart of fear that I could find that is showing any acknowledgement of any kind of a fear trade. So for now, the market does not think that this thing that's going on with Israel and Iran is a big deal. Even if everything you see in the news is really, really bad, it's just not in terms of the market. And then Bitcoin, we've done Bitcoin a bunch. I just wanted to point out this one thing. This was, a lot of people think that Bitcoin is part of the fear trade also, and Bitcoin actually dropped pretty significantly. This was the Thursday. So Bitcoin trades 24 hours. So it fell pretty good on that Thursday, but actually most of that happened before 11:30 p.m. East Coast time when the first salvos got going. So that fall was already going. And obviously, at least at this point, Bitcoin is not acting as like a fear trade, right? If you think Bitcoin is a digital gold, much like gold, you would expect Bitcoin to be going up on a fear trade, and it's not happening. But the other thing I wanted to point out was that we've been kind of consolidating sideways to down here since last week, but the stochastic is just about at oversold, and relative strength is right there on that 50 line. So there's a good chance anytime, I mean, stochastic is a leading indicator, and it leads relative strength, and it's a little bit more volatile than relative strength. But when stochastic gets down here, it's generally it's going up from there. It's not going down from there. So it's a time to watch Bitcoin when the stochastic is down here at oversold levels, if you're interested in getting into it. All right. And TSP fund charts. So again, kind of strange, right? As of Wednesday's close, markets closed on Thursday, so we'll see what happens on Friday. But as of Wednesday's close, it's basically flat. Again, no big decline due to a fear trade. So this is a weekly chart. This is the 20-week moving average line. Each one of these ticks is 1 week of price movement, and you get the relative strength indicator down here. So we had this big gap up coming off that April bottom, and we're inching higher basically every week. So there's really, as long as we're above that 20-week moving average line and relative strength is above 50, on a weekly basis, the C fund is looking good. S fund, not as strong as the C fund, but still, again, 20-week moving average line, we're holding above that, same kind of gap up we had in April. We're treading water there right above that 50 line on relative strength. So the S fund looks good. If you drew this down sloping trend line, we're pretty much right on it. If we can break through that trend line, there's a lot of people that think the S fund has a lot more potential than the C fund right now. If rates come down, it should create an environment that is outperforming for the S fund versus the C fund. And the I fund, interesting. Maybe it's beginning to crack a little bit. I would love to see the I fund come back down and find support at this 20-week moving average line. It would be a great place to get into the I fund. It's really, really overbought in the short term, and maybe this is the beginning of some kind of correction. I don't think it's going to be I don't think we're going to get below these lows at all. I mean, I think we need a pullback. We come back and get a pullback, but I think the I fund goes higher from here. Could be wrong, but it looks like a big rotation out of U.S. stocks and into international stocks. And then the F fund, again, you would expect on a fear trade that we would have seen the F fund really spike this week, and that did not happen. So the F fund has been in this really tight consolidation here for quite a while, almost the whole year to date. If rates come down, the F fund goes up. If rates go up, which nobody thinks, at least the Fed is going to raise rates, but the bond market certainly has something to say about it. So if rates come down, the F fund goes up. If rates go up, the F fund goes down. And the G fund always goes up and to the right. And that is basically it. But the thing was, I had a lot of questions this week about, when we saw it in the Facebook group, a lot of people are concerned, as they should be, about this conflict.
Yeah.
And I don't disagree. It's just that it's not playing out in the charts yet.
Right. And, we don't say this as much anymore, but we used to say it a lot. Like, nothing, it's all built into the price. Right. If you believe in technical analysis, right? If you believe that, the chart tells you everything. And so the chart's telling us what is actually happening, not what you think is happening. And that's what I like about technical analysis, is because if you're listening to the noise, if you're listening to the news or the people, which obviously, as I said at the beginning of the podcast, I'm not. And so I was looking at the charts, I'm looking at the market, but I didn't see anything going on. And that's a perfect example of that, right? It's like, okay, we're at the brink of, you got people talking about World War III and all, who knows what's going to happen? We're not in policy making decision jobs anymore, so we're out of the loop. But whatever happens is going to happen, and then the market will respond. And so don't respond until the market does, right?
That's a great example of it, because we talk about that all the time. Respond, don't try to anticipate it. Because if you tried to anticipate this, you would have gotten it wrong.
100,000%. If there's one thing that people can take away from listening to us, if you listen to us at all, is don't try to figure out what's going to happen. Just don't. It's not worth it. Wait and see what happens, and then respond to that. And you're going to be in far, far better shape. Because if you jumped out of the market in some capacity in the last week because of all of this, there's no reason to right now. Nothing really happened. If you go back and look at all the charts that Jerry just showed you, as far as the markets are concerned, right? I'm not saying what's happening in global, politics, but as far as the market's concerned, it's not responding yet, and when it does, you'll see it. It'll be immediate. My gut tells me that, I think that people are so used to chaos and uncertainty right now that they're getting better at just waiting. Let's just see how it plays out. You know what I mean? We'll see. I don't know. I think either people are just numb to the chaos, right? To the uncertainty. They're just like, I'm just going to sit here and wait and watch. And now when I say people, I don't necessarily mean retail investors. I mean big money.
Yeah. Well, as far as the big money goes, a lot of them did not get the rally off that April low.
Yeah.
And so anybody who got in recently, they can't get out now. I mean, I think you're on to something there with that. Yeah. If you're big money, you had to see this thing last week kick off and be like, because they had just gotten back in on that gap up that we looked at on the weekly charts, and we're not that, they didn't get the biggest move off the bottom, and to get out now because of this conflict, they're not, because they want to make sure something serious is happening before they get out.
All right, guys, if you have any questions, you put them in the comment section wherever you find this video. And if you don't have a comment section, you can always email us at support@growmytsp.com, and we'll get back to you. We're going to be on the road for the next several weeks, so this is how the podcast will be. Excuse me, guys. Give us some comments back of how you like it, whether being in the studio matters, or is this just as good? Because I'm curious about that. We haven't really heard anything from anybody, whether they care. So it'll be interesting. But all right, guys, hope you have a great week, and we will see you next time.